Alright, so we got this problem. Hopefully you've worked it. And so we're going to try it. I'm going to do it exactly like we did it in the other examples. So we got a premium, you got claims, LAE, expenses. That's going to give us an underwriting gain. We'll have investment income. We'll have net income after that. We'll have capital required. Required capital, I said it backwards. Required. Wait, excuse any typos. Then you have average required capital. We have the change in required capital. And we have net income less change in required capital. And then we have return on capital. So when you set it up, you'll do the current year. So the current year we had 400 in premium, 285 in claims, 3570. So 400, 285, 3570. Whoops. All right, I don't know what this is doing to me. 285, 35, 70. So plus your premium, minus your claims, minus your LAE, minus your expenses. So we have a 10. Our required capital is the premium divided by 3. So 133.33. And then we have our claims frequency growth. So growth, frequency, and severity. We have LAE growth, frequency, and severity. So hopefully if you didn't set it up like this, you might pause this video and go set it up like this so you have all the pieces. You have underwriting expense, growth. You have the timing on all of them is the same, so I'm just going to do that once. They're all 0.5. You have your investment return, and you have your required return on capital. All right, so we've got everything set up. So our frequency of our claims is going to be, it's going to grow by 3%. The severity is going to grow 3.5%. For LAE, it's going to be 3% and 2%. For expenses, 2.5%. And they all have the same timing, 0.5. Investment returns, 4%. Return on capital, 5%. Let me change all these to percents because they all are percents. And so then we do the next year. So we don't know what the premium is. I'll just plug in 450 just to get started. So our claims are going to increase by 1 plus the frequency times open parentheses, close parentheses times open parentheses 1 plus severity. Our LAE is going to be the same thing, 1 plus frequency, close parentheses times 1 plus severity. And expenses times 1 plus growth in expenses. And so I can copy this formula over. We'll just take 450 minus all of those, and that gives us our underwriting gain. Our investment income, we got to look at floats. So return. So we'll do the present value of these items. So the present value claims, we'll take our expected next year claims divided by 1 plus our investment return. I'm going to lock that in. Raised to the 0.5. I'll lock that in. Close parentheses. That 0.5 shouldn't be 50%. It should be a decimal. And we should be able to copy that down, right? Because if we lock them in, we can copy them down. And so we take our investment income is going to be the sum of the undiscounted claims, LAE, and expenses minus the sum of the present value of those, plus we're going to take the investment return times our beginning capital. There's our investment return, our net income. You just sum those two together. Our required capital is whatever our premium is divided by 3. Our average required capital is simply the beginning and the ending required capital divided by 2. The change in required capital is the 141,667. I'm sorry, the 150. This year's required capital minus the previous year's. Our net income minus the change is that, and so our return is the 34 divided by the average. All right, so our change in required capital is 150 minus 133. Our net income minus the change is 34, and then we take that net income and divide it by the average required capital, get our return. And so over here, I'm going to take the return on capital minus the required return on capital, and then I'm going to multiply that by, say, a million, just so I get a big difference. And so what I'm going to do is I'm going to do data, what if, goal seek. I want to set that difference equal to 0 by changing my premium. And there it is, 412,729. And my choices were 412, well, the two choices were 412.73 and 431.84. So the right answer is 412.73. That won't get you exactly there. And this is the best answer, but 412.73. It is still around the 7%, it looks like, even if you go out a couple of decimal places. It goes out, it's real close at 7%. So yeah, I don't know how many decimal places we go until we get, yeah, so it's right at 7%. If you want to get really close, you use goal seek and you get exactly the 7% return. So how I put this on the exam, I don't know. I wish you could actually do this. What I just did, I wish we could do that at exam. I just don't know how to do that without you having access to all of this. So it's a little bit difficult. But that's the approach. That's what the exam question used to look like in the past. Exactly like this. In reality, what they'll file is they'll take the 412.79 divided by the 400 minus 1, and they'll file a 3.2% or 3.18% increase, which would probably be approved because it's less than 5%. 5% has been historically, maybe they're lower now because inflation is so much slower now. Maybe 2 or 3% is all they'll approve now. But that's the process. So take a chance to step back and think about what you just did, because if you understand this problem, even if you're an actuarial science major and you'll have different formulas that you'll have to learn, you're doing the exact same thing. There's no difference. It's just I've broken this up as a finance person. If you understand what's going on here, you now have a chance to go back and really rethink what we did on paper 1 and this whole concept of float. We get the premium today, but the claims are paid out over the next, on average, 1 year. We're paid out over the next year, so on average half a year, since some will be less than half a year, some will be more than half a year, so on average 0.5 years. And because of that, we get to earn 4%, and so that 4% gives us our investment income, plus we also get to reinvest the capital we had at the beginning of the year, and so that gives us a return. Unfortunately, because the business is growing, we have to hold more capital, and so we're going to actually penalize ourselves for having to hold an extra 4.24 in capital. And so our return is 7%, return on capital, taking out the required extra capital. So hopefully that all makes sense. Oops. So where do we go from here? What I want to do next is work through Schedule P and really just understanding how Schedule P works. We'll get back to Schedule P when we look at the financials for companies. but I want to do some Schedule P. I think especially actuaries are going to find it very interesting, but finance majors as well. Schedule P is an incredible part of the financials for insurance companies, which are very insightful. If you work at a company and you're an analyst for an insurance company, a property and casualty insurance company, the fact that you know about Schedule P and what's in it will give you a huge advantage. I think there's a lot of people in finance that don't know that schedule's there. So next class, we'll get into Schedule P and what that means for you. So we'll stop it there. I'll give you 15 minutes to work this problem. That plus a 10-minute class today should be a pretty full class.